Let's say you just had a liquidity event. Maybe you sold part of your business. Maybe you exited entirely. Or maybe you sold a piece of real estate. And now you're sitting on a $500,000 capital gain. That's when someone inevitably brings up something called an opportunity zone investment. They'll say you can defer taxes, maybe even eliminate some of them. It's one of the best strategies out there. But the real question most business owners should be asking is this actually a good strategy, or is it just overhyped? And before we get started, I'm John Moriarty, co-founder and managing partner at E3 Wealth. We work with entrepreneurs and high-income households on tax strategy, liquidity events, and long-term wealth planning. Today, I want to walk through a real-life example of how opportunity zone investing works, using a $500,000 gain, and more importantly, when it actually makes sense. At a high level, opportunity zones were created to encourage investment into designated areas by offering tax incentives. The idea is simple. If you reinvest a capital gain into a qualified opportunity zone fund or QOZ fund, you may be able to, number one, defer taxes on an original gain. Number two, potentially reduce part of that gain and eliminate tax on future appreciation of the new investment. But the details matter a lot. Let's walk through a scenario. You generate a $500,000 capital gain from selling part of your business. Normally, that gain would be taxable in the year of the sale. But instead, you decide to reinvest that $500,000 into a QOZ fund. Here's what happens. First, you can defer paying taxes on the $500,000 gain, but not forever. That deferred gain becomes taxable in the future or when you exit the investment, whichever comes first. Now, the new tax law, the One Big Beautiful Bill Act, outlines these terms for any new QOZ investments in the 2027 tax year. So right away, it's important to understand this is not tax elimination. This is tax deferral. The real benefit, future growth. Where opportunity zones become more interesting is on the new investment itself. If you hold that investment for at least 10 years, then any appreciation on that new investment can potentially be tax-free. So if your $500,000 grows to $1 million over time, that $500,000 of additional gain may not be subject to any capital gains tax. That's the core appeal, the trade-offs. But here's where we need to be careful because this strategy comes with real trade-offs. First, liquidity. Most opportunity zone investments require you to commit capital for 10 years or more. That's a long time to lock up your money. Second, investment quality. Not all opportunity zone deals are created equal. Some are excellent. Others exist primarily because of the tax incentive, not because the underlying investment is strong. And third, timing. You only have a limited window, generally 180 days from the date of the capital gain event, to reinvest into an opportunity zone fund. Miss that window and the opportunity is gone. When does it make sense? So when does this actually make sense? Typically, for business owners who have recently realized a large capital gain, are comfortable with a long-term illiquid investment, and already believe in the underlying deal, even without the tax benefits. Because the tax advantages should enhance a good investment, not justify a bad one. On the other hand, this strategy may not make sense if you need liquidity in the near term, or you're unsure about the investment itself, or pursuing it solely to save on taxes, because deferring taxes on a poor investment outcome doesn't create value. The biggest misconception around opportunity zones is that they are a tax strategy first. In reality, they're an investment decision first, with tax benefits layered on top of it. And like any investment, the quality of the underlying asset matters far more than the tax treatment. If you've recently had a liquidity event and are evaluating what to do with your capital gain, opportunity zone investing can be a powerful tool in the right situation, but it's not a default answer. It's one option with a broader strategy. If you'd like help evaluating whether an opportunity zone investment actually fits into your financial plan, we invite you to schedule a conversation with our team, because the goal isn't just deferring taxes, it's making decisions that move your long-term plan forward. Thank you.